So welcome everyone, and welcome to the panel. It's quite a pleasant surprise to be on a gender-neutral panel. Often on these occasions, it's not quite like this. If I can just start with my presentation, I'm going to try and frame what the current environment looks like, and then I'm going to hand over to the panelists and ask a few questions. So I was asked to... Sorry, I'm flying past it and actually was looking at the wrong screen. How funny. It would be here. Okay, so effectively, some numbers just to start the session. The current global institutional pension fund assets in 22 major markets grew to 36.4 trillion as of 2016. Assets under management by pension funds across 16 major African markets amounted to around 334 billion in 2014, according to the Bright Africa report by consultancy firm Riskura. And then the third number, 93 billion, is what the World Bank estimates Africa should spend on infrastructure. And very much to what Mr. Gatti was talking about, that's the element that hopefully we'll be able to talk about on the panel. But this represents 5% of GDP. Each year on infrastructure, and the African Development Bank notes that there's about a $50 billion financing gap to reach the goal of 93 billion. So there's a lot of work to do. Some of the themes that we're seeing, the global rebalance as a firm, with populist wave and changes in the Western world. We've seen Trump, Brexit, lots of things going on in France at the moment. Have led to an increased protectionism and decreasing investment flow into Africa. And that effectively means that it's really going to be up to Africa to ensure Africa's growth and funding. So I think as much as this is talking to an international base of investors, this is also about talking to intra-Africa investors and making sure that they understand the opportunities that exist. Big data is a big topic. Just to talk about the fact that my firm actually, in a given day today, we process more data in one day than we did in a month 5 years ago. So I think we're all faced with that challenge. FinTech and RegTech, two massive, time-consuming and significant investments being done globally by a number of technology partners. The Financial Technology Partner states that fintech companies around the world have raised a total of about $36 billion in 2016. There's a massive drive towards reducing costs and improving efficiency, and I think that massively impacts our industry as a whole as well. So spend on RegTech, approximately 80 billion is being spent on governance and risk and compliance, and that's looking to reach about 120 billion over the next 5 years. And that covers things like, Hubert, you talked about Basel regulations and MiFID II, the likes of FRTB, etc. So massive funding going into that. This slide really talked about African pension allocation and asset allocation, and effectively, in most OECD and many non-OECD countries, bonds and equities remain the two predominant asset classes for pension funds. Globally, there is a larger allocation to equities, and in Nigeria and East Africa, significantly on the graph behind me, asset allocation is dominated by fixed income allocations. And that sort of constitutes mainly local bonds. This typifies one of the larger challenges I think the pension fund industry faces, because it's really about identifying appropriate local investment and development opportunities at the same pace as asset growth in the respective markets. The graphic here is pretty difficult to see, but this was really just to highlight bond yields from a number of African countries. I've taken Nigeria, Kenya, Zambia, South Africa, and represented that versus just a couple of the yields coming out of the US and the UK, just to highlight that we've got to be mindful that yields are high, but so are risks, and we're all too familiar in South Africa with our recent credit downgrades. But I know Namibia proudly has a AAA rating, so there are a number of key countries on the continent. Currency risk, and this I think affects all of us. Effectively, regulation can also enable regional and international diversification. So the obvious thing is to take advantage of that. And I think Namibia, I think hopefully, David, you can talk to this in the questions, but you're allowed 35% of assets outside of the common monetary area, being Lesotho, South Africa, Namibia, and Swaziland. And however, there is a limit of 30% outside of Africa, whereas a country like Botswana is able to invest 70% abroad. And I just want to highlight, obviously, we're all very familiar with currencies in our respective African markets, but you know, when you do make an investment from a South African perspective, let's say into a Nigerian asset, we have to go from rand into dollar into naira. So effectively, you've got currency risk on multiple levels that one has to factor in. Looking at growth, and hopefully this can talk a little bit to something you're going to talk about, Teresa. Africa is facing a mixed outlook for growth, and growth forecasts for the continent are now expected to be lower than the 5% average over the past decade. And this is largely due to the dip in commodity prices and the economic slowdown in China. But a number of countries are growing above that 6% average per annum, and foreign direct investment inflows continue to rise in those countries. Overall, the divergence of African economies makes it imperative to address the challenges posed, and by growing the unemployed youth population, climate change, amongst others. So countries like Nigeria, or Lagos in Nigeria, you know, not the capital, but definitely a commercial hub, is growing at about 77 people per hour. Countries like Kinshasa, DRC, are growing along the Congo River at about 61 people per hour. I mean, those are astonishing numbers. So just to put that into perspective, the rate of change is immense. The impact of headwinds for commodity-dependent countries has focused attention on the urgency for economic diversification, revitalization of manufacturing, and harnessing of human innovation in order to weather these economic storms. So investments in private equity and emerging markets has historically come from DFIs. Pension funds are slowly joining in, and I think countries like South Africa, Botswana, Nigeria, and Namibia have led the way of alternative asset classes such as private equity. South African pension funds, for example, have been active in African private equity investments both locally and across the continent, which have been enabled by regulatory changes. So since 2011, Regulation 28 has governed the law for pension funds in South Africa, which allows 10% of pension assets to be invested in private equity, which is an increase from the previous 2.5% that was allowed. The South African Government Employees Pension Fund, which is the largest pension fund in Africa and the 7th largest in the world according to the UN, with over 1.3 million members, in 2016 launched the Pan-African Infrastructure Development Fund, and that was able to raise about $627 million, and that's been dispersed. The South African Eskom Pension Fund in 2014 invested $30 million into infrastructure projects through private equity house Abraj. So we've got 2 members on the panel from both institutions, and as well as a mobile phone infrastructure investment in London's Helios. And Sibusiso, hopefully you're going to be able to talk a little bit more about that. So these were some stats recently released from our Deals Intelligence first quarter investment banking results. M&A on the continent, the largest deal was ExxonMobil, who agreed to buy 25% of the stake of a Mozambique liquefied natural gas project from Italy's Eni for $2.8 billion. The deal was the largest to be announced in the region during the first quarter and helped boost the deals in the energy and power sector. So that highlights, you know, the trends in the industry on the macro industry level, and I feel that's a good indicator of some of the key investments that are being made across the continent in specific sectors. The value of announced M&A deals and transactions, you know, it's been the highest opening quarter total in the past 6 years, which is interesting because it's been on a downtrend. Inbound M&A reached a 7-year high of 6.4 billion, and that was mostly made up of the United States, China, and Switzerland. Domestic and inter-sub-Saharan Africa M&A totaled 1.5 billion, and that's up 130% year on year. Outbound M&A declined slightly, and South African overseas acquisitions accounted for about 59% of the outbound investments. Equity capital markets, so just quickly going into 28% less than the value recorded. Okay. I will jump through this quickly on the basis of time. I do want to touch on this topic. Investors are responsible for over 60 trillion of assets under management, most of which is in fixed income, and have signed up for the principles for responsible investment and are looking for suitable investments. So a massive focus is on ESG, environmental social governance standards, and the move towards more integrated approaches to managing ESG factors have been through better stewardship are critical. So people are now focusing on interests of investors and societies for the long term where they're likely to converge. Risks are increasingly personal and human, and knowing your supply chain now is keeping CFOs up at night. We've got a lot of data that talks to risk in that space, but specifically this is one of the trends. Modern slavery, just to give you a quick example, was one element of, this was a mica mine in India, where understanding your supply chain is critical to understanding your exposure. VW were quite poorly hit by using paint that they used in their cars that were actually from mica mines and slaves being used in those mica mines in India. So things to look out for, I think, are really high on the agenda. And then terrorism, sadly, is reaching and showing funding from terrorism, so passing through many official systems and mechanisms which we need to be very conscious of. And we certainly don't want to be the corporate that was involved in distributing the mechanism that helped form part of that chain. So to hand over to the panel and to look at different asset classes and to look at different investments, I just want to quickly introduce my panelists on the left. So Teresa, on my left, is the Executive Director of Washington State Investment Board. She's based in Washington and I know travels a lot. Sibusiso Letuli, Chief Executive and Principal Officer of the Eskom Pension and Provident Fund. He's based in Johannesburg, South Africa, but told me that he is from KwaZulu-Natal, so very happy to be here. Tas Anvarepur is a partner and focuses on energy infrastructures for the Abraj Group. She travels between Dubai, Turkey, and the rest of the world. And David Nuyoma is CEO of the Government Institutions Pension Fund in Namibia. So there will be time for questions. I just want to quickly thank everyone. I think, Teresa, from the perspective of partners are key, and that we need to get in at the ground level, which you seem to be successfully doing. That Africa is certainly not one country, and that misnomer, I think, has clearly been explained by a number of examples from the panel. And making sure that we invest in cities and work on certain nuances around those cities, specifically around consumer consumption, and being quite targeted about where we invest and for what purposes, and what those regional unique selling points are as to why we're investing. And then ultimately, thank you, David, for I think the fact that we should be concerned about immunizing our assets is quite a great way of looking at how one needs to run the portfolio and making sure it's diverse and at the same time managing risks for the respective stakeholders. I'm going to open up the floor to questions. We don't have a lot of time. I was given a couple of messages about time. We suddenly gained a couple of minutes in time. I think we've still got, if I can just make sure, another 10 minutes for questions, or 5? Okay. Does anyone have any questions that they'd like to pose to the panel? Thank you. There's a mic in the front.
Thank you very much for what is a very illuminating panel. But considering that most of the companies in Africa that are the high growth companies would be classified as SMEs and SMIs, and significantly the PE or the investment climate does not really cater for that, how are you going to extract real value whilst contributing to the growth of the continent? Because I have always advocated that the PE industry needs a totally different model for the continent.
You'd like to take that? You'd like to take that, Taff?
Well, I think it ends up with me, so you're absolutely right. But look at the Braj model. Actually, we have offices all over the world, and we have 7 offices in Africa. I think it is very important because through 7 officers, we basically know what is happening in the ground. And the other advantage of having a global presence in all emerging markets, we only work in emerging markets. So when you grow the companies and you link them with the other continents as well. I'll give an example from outside of Africa. We invested in a company in Peru. Today, that company actually has branches in Thailand and in other Asian countries as well, but also in Paris. Although we don't invest in Paris, but we were able to move the company from one continent and make it international, go and invest in other places. I mean, we have very heavy investments in North Africa. Our next move will be basically linking North African and also Sub-Saharan African companies. By the way, the number earlier I mentioned, they are not actually, that fund is not actually covering North Africa. We have a separate fund for North Africa because North Africa is part of MENA for us, which means that now these 2 different funds will be putting partnership between the companies they are investing in to expand their markets. I mean, I gave the example of FundMig. FundMig is a very successful story for Abraj, and same thing with Lipstar. And we had very successful investments. We had also very successful exits. The whole idea is growing those companies which you called as SMEs.
If I may add to, it's a very good question and a practical one. Through our unlisted investment program, specifically in Namibia, one of the funds that we financed, even before the regulation required us to do so, was a fund that was to promote and invest in small and medium enterprises. Actually, there were 2. One was focusing on renewable energy to rural communities to acquire solar panels. And it has been very successful. The second one was to promote small and medium enterprises, especially to procure services and contracts from government as well as from large enterprises. These 2 funds have demonstrated that where you have appropriate skills, where you do your work professionally, you can actually reap rewards. And I must say, when we did the second allocation of unlisted investments, we decided to, amongst all the 11 that we had, only 2 succeeded to move to the next stage. And one of them was those that participate in the small and medium enterprises. And on a yearly basis, they are the only ones who have been actually giving us dividends. If you come in my boardroom, you'll see that I deliberately put the dividend check in a frame just to show that there is also light at the end of the tunnel when it comes to small and medium enterprises. But we have to do our homework. You have to put up a support framework. You have to put up mentorship, and you do the job the way it's supposed to be done. Then you can reap the rewards.
Thank you, David. I'm going to shine the light on the gentleman over there who has a question.
Yes, just very, very briefly, in the interest of time, could each panelist just show very briefly by indicating a number, range from 1 to 10, 10 being the most important, as to how important country and corporate ratings are for you when you consider either an equity or debt investment opportunity. 10 being the most important. And yeah, my name is Admas Sutadas. I'm the president of TDB.
For us, it would totally depend on what asset type. So if it's a bond, obviously the rating's very important. In equities, it's not going to be nearly as important to us. We'll do a much more fundamental bottom-up analysis.
Yeah, I think...
Do you have a number for each?
Yeah. Look, if depending on the asset class, if you're looking at the credit, bonds, obviously the rating of the country is quite important. Because you then, would need to and there's also mandates and limits in terms of what we as a fund can invest in. So it would be very important. Whereas if you're looking at a private equity, you then would focus differently. So the rating or the weighting of the country's credit rating would still be important, but would have a lesser weighting.
Yep.
You're not going to get your numbers.
Because in growth investments, we focus on the sectors, not the countries. Yep. So I will refrain from giving any kind of rating.
Yes, it's a very interesting question considering what is happening today. Yes, we got an upgrade recently in Namibia after serious austerity measures were implemented. But from a pension fund and investor perspective, initially when things became a little bit extremely volatile around here, we were worried. But we did an assessment last week, and we said, at the end of the day, it depends really on your asset that you have chosen and how well that asset was structured. And in that context, we realized some of the assets actually have performed better, partly because currency has changed the other way around. Resources have become much more interesting nowadays in this part of the world. So it's almost neither here nor there. It depends really how you want to look at it. Thank you.
Very much. Thank you very much to the panelists and to the audience. I think we don't have time for any more questions. Thank you. Thank you.
Doing business in Africa. You can't afford to be without Africa Investor.